Welcome to Market Peeker. Ever wondered about the different types of Forex orders and when to use each? Today, we're breaking down the three most essential order types: market, limit, and stop orders, so you can trade smarter and stay in control. Let's dive in. A market order is the simplest one. It's used to buy or sell a currency pair immediately at the current market price. If you want to enter or exit a trade instantly, this is the order to use. But remember, in a fast-moving market, prices can change quickly, so you might not get the exact price you see. Limit orders allow you to buy or sell at a specific price or better. For example, if you want to buy EUR USD, but only at 1.1950, a limit order will automatically execute if the price reaches that level. Limit orders help you enter the market on your terms and can be great for buying low or selling high, but there's no guarantee the price will reach your target. Stop orders are used to enter a trade once the price reaches a certain level. Let's say EUR USD is at 1.2000 and you want to buy if it hits 1.2020. A stop order will only activate if that price is reached. Traders use stop orders to catch breakout moves or protect their trades with stop losses, keeping risk in check. In short, market orders are for instant trades, limit orders for specific price targets, and stop orders to trigger at a certain price. Each order type has its place, so choose the one that fits your strategy and market conditions.